Well, welcome everybody to another episode of Cross Country Super Podcast. And this episode is proudly brought to you by Zagga, generating stable, fixed income style returns with an investor first approach. Why zig when you can Zagga? And of course, I'm joined by Jemma Sanderson, all the way from Perth. It's great to see you, Jemma.
Good to see you, Darin.
And look, if you're watching us on YouTube or whatever, you can tell that we've got the memo today because we're both dressed in white. So very well coordinated, which
very well coordinated today.
Which is just really coincidence, but I thought because I do get critiqued on what I wear, but not. I won't tell you who that critique
by me. It's always by me.
Anyway.
We have the banter. We have the banter.
Yeah, so you think you're a tough audience. Co-hosts can be just as tough, if not tough. Anyway, today we're going to talk about the transfer balance cap and most things about that. I can't ever say all things about that because there are so many things to discuss about most of these topics that we can't discuss all things about them. But today we're gonna cover some of the stuff to do with the TBC, as it's widely known as. And I suppose I'm going to kick it off, Jemma, because obviously a lot of the economic figures came out towards the end of last year and early this year, like last month and this month. But one of the talking points or one of the anticipations was that there was going to be another round of indexation applied to the transfer balance cap if the CPI number was to trigger that. And there was a lot of anticipation that it probably would happen. But lo and behold, it didn't happen. So we're still at the $1.9 million, aren't we?
That's right. Yeah, we certainly are. And it was quite interesting even when that jumped from 1.7 to 1.9 at the time. Like that was a big jump for only over sort of a short period of time, because it took a while to go from 1.6 to 1.7, and then it jumped, within a couple of years to the 1.9. So it's one of those thresholds. At least it does get indexed, so that's of benefit. But we won't talk about what isn't indexed.
Well, it gets indexed, but geez, the indexation is a little bit complicated, or it's not really complicated. It's not straightforward. And with the first round of indexation that you talked about, when it went from 1.6 to 1.7, we had the introduction of this concept of now there's a general transfer balance cap and a personal transfer balance cap, just to make administration that much easier for everybody out there. What are these concepts, and as a practitioner, how difficult is it to sort of monitor that for clients?
So helpfully, if again, it's all about the information being, garbage in, garbage out, basically. But the tax office does keep a record of what your personal transfer balance cap is, either through the tax portal if you're the personal tax agent, or the individual's MyGov. So at least that's something. But at the same time, it's only based on what's been reported. So if it hasn't been reported correctly, or it hasn't been reported at all, and we encounter that a bit, where you've got the form. Here's the T-bar form. There's another great acronym, the Transfer Balance Account Report. Here's the T-bar, but there's nothing on the person's transfer balance account to represent that. Anyway, so you can at least obtain that information. But again, if it's not garbage in, then you're going to get garbage out. But so that's helpful. But the other consideration with that, and a lot of people were thinking, oh, great, I put my 1.6 in, it's gone to 1.7. Does that mean I can throw another 100 grand into pension? And this is where this proportionate index, when it gets indexed, the proportion that you can have of that indexation depends on your unused transfer balance cap amount. So it did become really quite complicated from that perspective, only because it's the highest amount you've ever had accounted towards your transfer balance cap. So if we use an example of back at 1 July 2017, someone had $800,000 in account-based pension or retirement phase, and so they used half their transfer balance cap. So that means their used proportion was 50%, so their unused proportion, helpfully, 50%. So in the indexation to 1.7, they would then have half of that indexed amount they would have available to put towards another pension. Now, if they didn't end up using that, then that's all fine. They would just plod along. And then with the additional indexation that's happened recently, so now it's $300,000 worth of indexation from the start, then they would get half of that again with that 50%. But let's say they started with, and I've got to use some numbers here to make it easier for my brain. So they started with $1 million of the 1.6, and then they did a partial commutation of that amount to pull out a big lump sum and buy a boat or whatever. I'm making some stuff up here. So it wouldn't be that they came back to its 50% of the 1.6 now. It's that they used $1 million to start with. So their indexation amount is only the unused based on the $1 million. So from that perspective, you've then got to look, well, what's $1 million on 1.6? And then you have the unused amount, but you round, and I always get this around the wrong way. You basically end up with a situation that if your used amount is, say, 51.8%, you actually round that down to 51. So then you'd have a 49% unused amount that you get to use. So it's, simples, right? Simples.
Yeah.
So there's that element. And then the other consideration with that is just watching out for, reversionary pensions adding to the cap, or you start a new pension from a spouse. Like, all of those things need to flow through that transfer balance account. And again, as long as that all gets reported correctly, then that can all work. We are certainly seeing challenges with people with the cap defined benefit income streams and that reporting. So yeah, it's not as simple as it could be.
No, I mean, just to hear you explain it, the level of sort of mathematical complexity that goes with the proportionate way it's been applied. I mean, and of course, it just builds upon itself, because if, say, for example, the 50% that a person was potentially entitled to when the first round came through, because they'd only used $800,000 of their transfer balance cap allowance, if they used another bit, then that would count, which means that the subsequent ones, the percentage continues to change. The one bit I don't understand, but it is consistent with superannuation policy by the looks of it, is if somebody used 1.6 originally, what's the damage of just giving them another $100,000 to use? That's the bit I don't understand. It's like, well, what can possibly be the harm there? It's not like it's another $1 million or $2 million where you could start to say that, well, they're significant amounts and maybe we should look at that. But the amounts are so...
We're not talking sheep stations, are we?
No, I wouldn't say they're inconsequential, but they're not so serious and so large that you'd say that, oh, well, no, we can't allow that to happen. And instead, you create this spaghetti-like structure where people have to unwind. Oh, sorry, where am I at? And sorry, what's the top cap now? And how much have I used? Yes, I agree, Gemma. We should be thankful for small mercies, and the ATO monitoring it is one of those. But again, that's based on the accuracy of reporting.
Yep, that's right.
It doesn't necessarily mean that you can absolutely guarantee that figure is going to be accurate, which basically means prudent practice would suggest that, well, especially for advisors, you should continue to monitor the situation yourself.
Definitely. Yep.
Because otherwise, then you get into all sorts of trouble with, breaching the caps and that sort of thing. I just don't understand why it has to be made so complex.
Well, I mean, I can't comment on the policy background. I can speculate also. I would presume that that's on the basis that if you were in retirement pension phase back at 1 July 2017 and you used your 1.6, then between then and it being indexed to 1.7, you've had the benefit of that growing in that tax exempt environment, and perhaps by the time that it gets to that, you actually are at 1.7 perhaps with your balance, and how that flowed through. But again, how long's a piece of string in terms of making that comment about the policy. And just to add to your the comment and the complexity of it all, is you can have situations. So every time you might do a commutation and it's a debit against the transfer balance account. So what can happen there? So I'll use my example of the person who put in 800,000. So let's say they put in 800,000 back. That's what their retirement phase account was worth at 1 July 2017. So they've used half of their transfer balance cap. Then 2 years later, when it's worth $1 million, they do a partial commutation of 200,000. So that comes off their transfer balance account when that payment gets made. But they've still got left in their pension 800,000. So it went up to $1 million, and then they took out 200. So that actually reduces down the amount assessed towards their transfer balance cap by 200. So they've now had 600 assessed there. So they've got $1 million left. Then say a couple of years later, that 800 goes up to another $1 million, and they pull out another 200 as a partial commutation. So their balance is still at 800 in pension phase. And now their transfer balance cap has gone down to 400 counting towards it. Then a couple of years later, it goes up to $1 million again, just through investments or whatever that looks like. They take out another 200. So then their transfer balance account, what they've got used against their cap, goes down to 200. So you could have the situation that someone has an account-based pension in their super of whatever the balance is, but their transfer balance account is almost zero or even negative. Because of the way that works, if they've had the benefit of that. So again, that adds a layer of complexity to these sorts of things as well, with how those, the way the commutations work. And back to with indexation, that could end up with everyone's transfer balance account or cap being 301 different ones. So, 1.6 all the way up to, but all in $1,000 increments, all the way up to 1.9 million. So that could be what anyone's personal transfer balance cap is. But then you need to overlay that with the perspective of, so say someone had used 1.6 to start with, so they've fully used their cap, so they've got no unused cap available. And then through the growth of investments, perhaps when it was a 50% minimum pension, because they only had to draw out half, then their assets have been able to grow a bit more. So say it's worth $2.1 million now. So if they are then the reversionary beneficiary, or they start a new pension from a deceased's account, they couldn't, if they commute 2.1 million of their pension, then they've got 2.1 million available to start a new pension. So you can have a negative amount. And again, so you could end up with the transfer balance accounts of people can be an infinite number of different amounts. So it's definitely added that layer of complexity. And we are still dealing with leading up to 30 June 2017, and then accounting for things, doing the 2017 financials in the 17-18 financial year, having to deal with all the CGT resets and all that sort of jazz, and the deferral. There's still a lot of assets that were subject to the deferral back then. And then, there's going to be that history and that legacy that we're going to have to be managing and continuing to be aware of. Because if that tax is only popping up when the asset is sold, then again, that's, quite a bit that people might be blissfully unaware. It's like, oh, that was 7 years ago. Who cares? We've now got a new regime with Div 296 tax. So Div 294, which is the transfer balance cap area, that's just another thing. It's like, well, hang on, mate. You've sold that asset now, and we deferred the payment of that tax. So actually the tax on it is, that amount plus the reset. So there's a whole bunch of things all happening there that we still really need to be aware of in that transfer balance cap area.
Yep, really straightforward. As you
really straightforward.
The interaction between the transfer balance cap and the transfer balance account almost completely non-correlated
Yeah,
with what you do and how you monitor that, which is, I'm sure, would be very confusing for people out there who obviously don't live and breathe this stuff to figure out, oh no, hang on, sorry, what's the transfer balance account again? Oh, what's the transfer balance cap? Now, speaking of its current level, really the only people who can take advantage of the $1.9 million is someone who hadn't had anything in retirement phase yet. So
that's right.
starting completely anew, the only people who can actually go the maximum amount are people who have never done anything in retirement phase yet.
That's right. Yep. So you're starting a fresh pension since 1 July. Yep. Otherwise, you've got an unused amount that you can use, or you don't have any cap available. So you just got a business as usual for those particular people.
Do you think the members and the trustees themselves really understand how that works? They don't think that, as in, they don't think that I'm going to get a boom or a real kickstart because it's gone from 1.7 to 1.9.
I think that there is an element of misunderstanding about that. So they see, the headline is this has been indexed, and we certainly get a number of calls where that has occurred, saying, "Oh, can I put more money into it?" And the answer might be. So what's the correct answer to those sorts of questions is always it depends, and usually when you look at it more closely, it's like, no, you can't. Oh, sorry. Maybe you can, but for anyone who's obviously fully used their cap previously, then they can't put any more towards it. So it's and that does make it a bit simpler from the perspective of saying, look, you fully used it, so you've got no unused proportion that you can have a look at. So that's at least straightforward. It becomes more complex where someone has an unused proportion. What does that look like, etc.
So, Jemma, are you telling me that when they see the news stories about it's been indexed, you're hearing a lot of woohoos from Homer Simpson to think that they're going to get a bit of a boost? I had to throw that in because
woohoo!
That's the Simpsons reference that you like.
Yeah, I love.
I got it in there. I got it in there.
Well, I think people think that, and then you have to give them that bad news, bear news. That's not how it works. But again, like most people, when this all got introduced, those people that were, a lot of members fortunate enough to have more than 1.6 million in their superannuation account. Some people were upset by the fact that they weren't getting the pension exemption on all those assets at that point in time. Others were very pragmatic about it and were like, well, we've had it pretty good for a long period of time. I think the biggest downside of those new rules at the time was that the transition to retirement pensions weren't getting that exemption, but that was a bit of not a loophole, but that was a bit of a boom at the time for the fact that you could get the exemption and pull down up to 10%. Those were great provisions, and they've still got their place, obviously, but definitely less so since the introduction of the transfer balance cap. And the other thing that comes with all of this is the reporting obligations. So every time there's a transfer balance event, it needs to be reported within 28 days after the end of the quarter of the event. And so that's an area that often doesn't get picked up. Again, you can go on the tax portal and see what the transfer balance account looks like, and then there's nothing in there, but that Homer has been in pension phase since 1 July, since before 1 July 2017. So why wasn't that reported? So then having to, report that correctly and all those sorts of things. So we did have that leeway of there was annual reporting for funds where there was less than $1 million for the members, for each member, but now for self-managed super funds, it's quarterly. And that in itself can be a challenge because often, so if I wanted to report, start a new pension today, let's say the person's hit 65 and, that's that golden age of full access to super regardless of working plus tax-free. So we start a pension for Homer today, but what's his balance worth? So if his balance is well over 1.9, that's reasonably straightforward to report because you just report 1.9. But if he's got super of 1.756213 at 30 June 2023, then what his balance might be now, you're just not going to know with absolute certainty. So there's just that, again, that time lag that comes through with how that works. So from that perspective, just again, it's an awareness consideration because you're probably in that situation. You don't want to report too much for Homer because then his unused amount, you want to maximize what the unused amount might be if it gets indexed. But again, even in the scheme of it all, if it ended up being 1.7 million of the 1.9 that he used, his unused amount isn't going to be enormous in the scheme of it where indexation applies. Plus, where would that extra amount get? When would you put more money into pension phase for Homer from that perspective? It would be if he had made another contribution, perhaps, or from a succession perspective, if Marge died and he ended up with a new pension or a reversionary pension. Anyway, again, it's not so straightforward.
No, it's an interesting point, Jemma, because obviously that new reporting time frame it is still fairly in its infancy, switching everybody over to a quarterly time frame, and we probably haven't seen what effect that has had since the implementation yet. I mean, certainly the ATO hasn't mentioned in any of their presentations about how people are going with the new time frame, because it was actually quite severe switching from an annual reporter to a quarterly reporter. There was no leeway. Once it got to the cutoff point, everybody was quarterly. There was no offer for this period. You can still have a period of grace. It was like bang, no, everybody. It's the new regime now. As I said, that only came in at the start of this financial year, so we're probably yet to see the impact that's had on how well people are adapting to that, and what sort of late reporting statistics there are. I'm sure the ATO will probably tell us at some point in time, but I'd be interested to know how well people are sort of adapting to that, because I mean that is quite a severe change going from an annual exercise to no, you've got to do it quarterly. And of course, again, like you said, you've only got to report these things when you've got a change to your pension status.
And I think that's the point. That's a good point, because it's only things that you need to report. So it's when you look at the headline of quarterly reporting, people panic, and it's like, well, no, actually, has there been a change? Have you done a partial commutation? Have you started a new pension? What might have what's an event that needs to be reported? Once you've started your pension and used your 1.9 or your million or whatever the amount might be, there might be no further reports or items that need to be reported for the rest of your life. So it's from that perspective. But for those people that are perhaps taking out their minimum and then doing partial commutations for amounts above their minimum, then that could be it almost akin to looking at quarterly IAS and BAS statements that might come through, or having to do quarterly pay as you go for those people under 60, where you've got to say, okay, Homer and Marge, what have you taken out? That was your minimum pension. What's it going to be a commutation, and what is it that we need to report each quarter from that perspective? And to your point, I haven't seen a late lodgement penalty or notice come through at all whatsoever since the introduction of these rules from the tax office. But I suspect that it'll be on its way at some point, because getting used to how that reporting regime works is certainly something that, that drop dead date of 1 July 2023. Again, a lot of people may be unaware that that's the case. And this comes back to also another consideration is the information about the transfer balance account is on the individual's tax office record. So it's through the tax portal if you've got a tax agent for the individual, or their own MyGov. So a lot of the time, what's being managed in terms of drawdowns and pension payments and partial commutations and the like, that often it's the tax agent for the fund may not be on top of that, because often it's a financial advisor, but the financial advisor doesn't have access to that information to check it without, because they don't have access to the tax portal. So they're relying on the either the individual tax agent or the individual themselves to get that information to then figure out what the reporting is. But the reporting obligation is with the fund. So this is that whole, everyone needs to collaborate and be on the same page, because if a partial commutation comes out, and a lot of the time, depending on whether the accountant for the fund has got the right software or they're on top of these things, they might not be aware that Homer took out $200,000 in the March quarter 2024 that needs to be reported by the 28th of April. The advisor knows and it's all been flowing through, but then the tax agent for the fund picks it up a year later and is like, oh, goodness, we didn't report that within the time frame. Oops, we better do that. You've got all the right paperwork in place, but it hasn't been reported. So again, just everyone being aware of that all happening. And likewise, pension commencements. So all the paperwork gets done often by the financial advisor, but that T-bar reporting is again the obligation of the fund. So it often gets done by the tax agent for the fund. And so if that line of communication isn't open, we've started a pension, Homer's taken out his $5,000 for the month. Here you go, Jemma. Here's all the documents. We'll sort out T-bar and go on from there. So again, it really, everyone needs to be on the same page and understanding it, which back to my previous rant is probably that it's complex and there's a lot of different balls being juggled that we need to be aware of.
I don't think anybody could argue that it's not complex, but as usual, we digress, Jemma. And
of course, we always digress.
In skiing parlance, we've gone off piste, so I'm gonna get back on the track now.
Back onto the green run.
Yeah, that's right. Back onto the green run or the black run, or however sophisticated a skier that you might think you are. So back to the transfer balance cap. We've been talking in the initial parts of this discussion about how it relates to pensions. But of course, this threshold is used to interact with a whole lot of other things as well. And while it may not be obvious or even logical on the surface of it, the general transfer balance cap also dictates what you can do with your contributions, in particular non-concessional contributions. And that's another thing obviously to be conscious about, and it probably is a good lead in. I know that we discussed this in a previous podcast, but it has been confirmed now that the concessional contributions caps have increased, have had indexation. Speaking of indexation, they've had another round of indexation applied to them, which in turn has obviously affected the non-concessional contributions caps as well, being 4 times the concessionals. And of course, that plays havoc with the bring forward provisions and that sort of thing. So getting back to the transfer balance cap, of course, that determines everything, doesn't it, Jemma? That 1.9 million threshold is very important there. Yeah,
so that's where the transfer balance cap and the total super balance, that is the interaction. So again, there's a misunderstanding. People say, oh, well, I've fully used my transfer balance cap, therefore I can't make any more contributions, but their actual market value of their assets has dropped or whatever. So they can do that. So but absolutely, the upper threshold for the total super balance for non-concessional contributions that's benchmarked to the transfer balance cap. And we will have that anomaly next year, because the transfer balance cap stayed at 1.9, but the concessional contribution cap was indexed, that those bring forward thresholds will actually go down next year.
Yeah,
so at the moment,
weird, isn't it?
It's totally weird. So at the moment, 1.68 to 1.79, 1.79 to 1.9. Next year it'll go to 1.66 to 1.78, and then 1.78 to 1.9. So it's very counterintuitive, but that's how the formula and the legislation works from that perspective. So I think, but the consideration there back to the transfer balance cap is the transfer balance cap is an amount that you had in retirement pension phase at a point in time when you started that pension, or multiple pensions. So that's what that figure is. So that's at the fixed sort of number for an individual, but then their total super balance will fluctuate depending on market movements and drawdowns and things like that. So the transfer balance cap, again, it can be static for the individual regardless of what's happening with their total super balance. And so that's something else to be aware of. And when you interact even that with the Div 296 tax, so some people will say, oh, well, transfer balance cap, I had my 1.6 type thing. And how does this all interact? Well, I've got some clients who have done very well from an investment perspective, and they're at 1.6 at 1 July 2017. Their pension accounts are now north of $10 million. So they're still 100% in pension phase with respect to that, but they're still getting the exemption. So from an exempt current pension income perspective, they're fine, but then we've got to overlay Div 296 tax. So the other thing that some people misunderstand is having to benchmark back to that transfer balance cap each year, and that's obvious with their pension accounts, and that's not how it works either.
Yeah, it's all. Did anybody say there were too many thresholds and too many thresholds at play here? It's a little bit like the KFC ad. Did somebody mention KFC? Because I mean, seriously, the intertwining of all this is very, very difficult to get a handle of and keep a handle on, to figure out what you can do. And of course, then if you go into breach territory, there's a whole nother world of hurt there.
And actually, that's a good point, because if you end up going over the transfer balance cap, which can inadvertently happen where people retire and they've got their own super interests that they've been accumulating over time, but they've got some historical, and we often see it, they've got a historical defined benefit scheme through a government employment from a billion years ago, or current, but they've also been accumulating as they've gone. And then that starts a defined benefit pension starts there. So that's got different treatment than just the market value. So you've always got to factor that in. So there was certainly situations, particularly at the 30 June 2017, where that resulted in excess transfer balance caps because that amount wasn't factored in or taken into consideration, or almost unknown, or wasn't disclosed by the client to their advisors. Oh yeah, that's right, I get that PSS or CSS or whatever pension of 20 grand a year. So they think it's like unremarkable or insignificant. It's like, okay, that's fine, but that actually counts towards your cap and has that consideration from that perspective. Right. So we've got to take that off the top line in terms of what we can then put in an account-based pension for you within your super fund.
I just thought it'd be a good chance to just clarify why those bands have come down. The way the formula works is that it's the transfer balance cap minus the current level of non-concessional contributions cap, isn't it? Which is why if that bit goes up, then and the other bit stays the same, all of a sudden your bands get
Yeah, so at the moment, it's 1.9 is the top. So then the next band is 1.9 less the single year cap. So 1.9 less 110,000 gives us our 1.79, and then the bottom limit is 1.9 less the 2-year cap. So that gets us to the 1.68. So when the single year cap goes to 120, it's 1.9 less 120. And then when the single year cap goes to 240, it's 1.9 less 240 to that why it backs down. So it's it again adds to the complexity. When it first was introduced, 1.6, 1.5, 1.4, yep, easy. But then when you actually look at how that mechanism works, and if anyone needs something to put them to sleep, I would encourage you to read the legislation about how the bring forward periods work, because it is quite mind-blowing. But those, we see that table that gives the thresholds, the number of years, and those sorts of things. That's the best avenue to have a look at. The other thing, just in terms of, so again, a lot of people misunderstand the interaction of the transfer balance cap and the total super balance. So it's just that for that benchmarking purpose that is there. So the transfer balance cap also has an impact on what the cap defined benefit income stream threshold is each year. So originally at 1.6, it was, so this is the amount of those people who've got market linked pensions or complying pensions in their superannuation. That's the amount that they can receive from that pension account tax free, this cap defined benefit income threshold. And then an amount above that they receive from that pension, half of it is taxable at their marginal rate. Now, originally with a $1.6 million transfer balance cap, that divided by 16 gave us the annual threshold, which was $100,000. As it went up to 1.7 million, 1.7 divided by 16 was the threshold, and now 1.9 million divided by 16 is the threshold. It's about $118,000 at the moment. So that's the other benchmark from that perspective. So just to, again, there's a misunderstanding that I witness of, well, I've fully used my transfer balance cap, so therefore I can't make contributions.
Yeah.
And they may well interact or align from that perspective. But if you fully use your transfer balance cap and then but your assets are now only worth 1.4 million, you actually have the ability to make a non-concessional contribution because it's effectively looking at the market value of those assets.
Yeah. All very straightforward, as
totally
you say, but keeps you and I in a job because
totally
about it, and you need to be able to navigate your clients through this very complex maze of thresholds and rules that they must adhere to.
And I think that's why, we're having these chats to try and bring up the awareness of these sorts of things so that then, the advisors out there or whoever might be listening can say, oh, that's right. I better just check that, or, that I need to do that for Homer and Marge because of this, and this. So it's a complicated area, and we're sort of touching at the surface on bits. But again, it's all about that awareness so that people can then you don't know what you don't know. So, or we just reinforce what they already know and it serves as a reminder.
Yeah. Now, we started off this discussion about transfer balance cap, and obviously that's related to pensions. So it's not quite off piece, but I'm sort of changing directions a little bit here, and we're going to talk a little bit about pensions now, Jemma. And in particular, one debate that goes on a lot, and that is when you start a pension, should you make it reversionary or not? Look, what are some of the, I know that there are differences, but what are some of the obvious pros and cons that people should probably consider when they're making that sort of decision?
It's become a lesser checkbox sort of decision. It's got much wider estate planning implications. And because of the way the transfer balance cap works, if it's reversionary or it's not, it's different. And so understanding how all of that works. Now, as a general rule, I don't like reversionary pensions, but that doesn't mean that I won't recommend them for clients in particular situations. So again, back to the correct answer to that is it depends on the situation. The
So
big ticket.
what don't you like about them?
So I don't like the impracticality of dealing with a super fund with a reversionary pension in it and overlaying the Div 296 tax. Having a reversionary account is actually often a worse outcome for Div 296 tax than if it's not reversionary. And again, one of the misunderstandings about reversionary or not is, again, I get a lot of queries saying, oh, well, it wasn't reversionary. Marge has died, it wasn't reversionary, so we've got to pay her account out as a lump sum. And it's like, no, back the truck up. That's not necessarily what you need to do. So just because it's not reversionary doesn't mean that Homer doesn't have the opportunity to start a new pension from Marge's account. And so with the differences, so reversionary, the pros of a reversionary is there's an element of certainty there, although that in itself can be an it depends outcome, depending on the deed, whether you've got reversionary documents that conflict with a binding death benefit nomination and what the deed says about that. But generally, you've got the situation that the reversionary nomination has that certainty of, I know then that if Marge dies, Homer will continue to receive those payments. So that's a pro from that perspective. But that comes with it a con, which is that in the year that Marge dies, Homer needs to make sure that he takes out the required minimum payment from Marge's pension, because Marge's pension is just continuing on to him. So whatever her minimum was for that relevant year, Homer needs to make sure he's taking out his account, his own pension benefit or minimum for the year, but also hers. And we see people come a cropper from that perspective. So that's one of the things. A benefit of reversionary is that the value at the date of death, so if Marge dies today, that value becomes a transfer balance credit in Homer's account in 12 months' time. So really Homer's got 12 months to deal with it. So he can run both, and I assume they've only got one pension each, both pensions for the course of that year, get the pension exemption with respect to the assets in those accounts, and then in 12 months' time, figure out, right, so this credit is going to pop up in 12 months' time in my transfer balance account. Will that result in me having an excess? And will I need to restructure my own accounts from that perspective, which generally involves him stopping some or all of his pension to receive her pension? It may result in him having to actually pay out or commute an amount out of superannuation entirely from her pension if her amount that was reversionary to him ends up being higher than what his available transfer balance account is. So, you know, that's complicated. That's in itself has Div 296 implications because it becomes his account straight away. So then it adds to his total super balance. So there's those sorts of things that come through, but mostly reversionary is certainty. Now, there was many, many years ago, there was a lot of uncertainty about the situation that if your pension wasn't reversionary, and do you still get the pension exemption on the underlying assets if it's not reversionary? And there was an ATO ID in 2004. So some people haven't even been in the industry since then, but you know, nerds like me remember this. 2004 688 that basically said if it's not reversionary, as soon as the person dies, that account ceases to be a pension. And then this big concern that they then lose the pension exemption on that. So a lot of people made their pensions reversionary to address that so that they didn't lose the tax exemption. But then the issue becomes with that is, oh, I've made it reversionary to my spouse, so we get the tax exemption. But do you really want your spouse to get it? You know, it's your second, third spouse. You actually want your money to go to your kids. So it's that wider succession consideration. So from that perspective, and then, even though that's what the tax officer's view was, that as soon as you die, it ceases to be a pension, in 2013, the legislation changed to confirm that if it isn't reversionary, as long as it gets dealt with as soon as practicably, then the underlying assets continue to benefit from the pension exemption. So that means that again, if Marge had $1 million pension and it wasn't reversionary, as soon as she died, it ceases to be a pension, but it still benefits from the exemption. And the benefit also of non-reversionary from that perspective is that in that year, Homer doesn't have to pay out the minimum of Marge's pension in that year because it ceased to be a pension. So if an amount does come off that account, it's actually either a lump sum to him from her benefit, or he would need to be treated as payments from his account. So there's, again, pros and cons. Now, in the situation where it's not reversionary, it needs to be dealt with as soon as practicably. So then from a transfer balance cap perspective for Homer, let's say, so firstly, is he the beneficiary in a binding nomination? Assume that he is. And so he's starting a new pension from Marge's account. Now, when does he do that? So he might wait from as soon as practicably perspective, wait for probate, wait for all those things, and then say, right, let's just do it at the next 1 July. Right, we'll start a new pension from the 1st of July. Now, it would be at that point that he would need to then look at restructuring his own accounts, and it would be the value of Marge's account at that time that is the transfer balance credit. So if, as opposed to with reversionary, you've got 12 months and it's the value at the date of death. So that's where it's a little bit different. So from a practical perspective, it's easier to say, right, 1st of July, new pension for Homer, restructure his accounts, move on. When it's reversionary, you've got the 12 months, but then you need to know the value of Marge's account. So back to this reporting regime. Marge dies today, so we're in the March quarter. Marge dies today, then the value of her pension account as at today's date needs to be reported by the 28th of April. So even though the credit doesn't pop up in Homer's account for 12 months, the event that resulted in the credit is today when Marge dies. So you need to value that as at today and report it by the 28th of April. Now, Marge has just died. And so do you think Homer's going to be able to say, oh, sorry, Homer, we need your bank statements and we need, unlisted, we need all this information to determine the balance of Marge's account when she died? It's going to be a non-event. So I suspect that there might be more and more reporting, or you've got that late transfer balance reports coming through from that perspective. So you've got that. So you need a value of Marge's account as at today's date. So that can result in extra work at the super fund level. Then in 12 months' time, when Homer has to look at his own situation and figure out how am I restructuring my accounts, so we might then know what the value at Marge's date of death was. But then what's the value at the date in 12 months' time? Because we will need to know the value of his account for restructure purposes. And so we've got two sets of potentially extra work in the fund from that perspective. Now, I'm doing the tax agent out of a job here from that perspective, because that is extra work. But I think as an industry at the moment, there's plenty of work around and people don't need that extra faffing around. And if you're conveying that to the client, okay, sorry, Homer, we need to do extra work here. And then in 12 months' time, we need to do extra work here. And it's going to cost an extra XYZ dollars. He might be going, Barleys, what? I don't, that all to satisfy these ATO compliant obligations. Well, they're satisfying Div 294, the transfer balance cap regime, to not have an excess, but it's a lot of extra work, as opposed to saying, right, Marge has died today, let's land on it at 1 July, is a new pension commencing for Homer from Marge's account. We can restructure his account. We might not know what the accounts are at that time, but we can at least draft all the paperwork in light of that and undertake that reporting from that perspective. So the challenge always with, I love self-managed funds, as we all do, and the people listening to the podcast. So we all love self-managed funds, but sometimes being able to land on someone's actual account on a particular day is always the challenge at that particular time. So there's just a couple of reasons. So with Div 296 tax being introduced, that's just added another reason why I don't like reversionary pensions.
Right.
One of the downsides, though, of a non-reversionary pension is if between the date of death and when you deal with it, the assets go up substantially, then you're sort of missing out there, as opposed to the reversionary, where if that happens at date of death is the credit in 12 months' time, as opposed to the value at the date that you deal with it. But from a pension exemption perspective, you still get the pension exemption in either circumstance, pretty much. Does that make sense? No, it doesn't. But we plow ahead.
Well, the conclusion is all of this is pretty complex stuff, as you can well imagine. And really does take specialist advice to unpick all of these items and make sure you navigate these waters properly. Now, you've made several mentions of Div 296 tax. I just wanted to clarify that is the new tax. You may not be familiar with it. It's starting to become part of the SMSF vernacular in the industry, but that is the new tax on total super balances over $3 million, which is set, if Labor stays in power, which is set to be implemented on the 1st of July 2005.
25.
It's 2025, sorry.
Let's go back to 2005, Darin, when it was so different. The podcast didn't exist.
Let's not encourage them to make it retrospective back to 2005, because if someone suggests that, I'm sure they'd probably jump on that bandwagon.
Yeah.
But so that's now commonly being referred to as Div 296 tax. So whenever you hear us speak about it, and probably in more presentations as you go along, it's certainly becoming more of a commonly used term now.
Yep, definitely.
And I'm going to throw you another "it depends" sort of situation.
Oh, love them. Let's go.
You touched on there, Jemma, because you mentioned about the application of as soon as practicable time frame with non-reversionary pensions, right? What
does that mean?
Yes. What is as soon as practicable? Now, I know that there's a rule of thumb out there, but what does it actually really mean?
So, it's again, it depends. And the rule of thumb that you refer to is it's again, about-ish 6 months. So, the tax office has generally been accepting of a 6-month period of time. If you're going to extend it beyond that, then it needs to sort of be justifiable. So where we encounter challenges, as an example, is someone dies and then it's a single member sole trustee fund. So who steps into the role? Well, you've got to wait for probate for the legal personal representative to even come in and do anything. So, there's an example that might take a while. Probate, we had a situation where there was contentiousness as to which will was valid. So did the second will, was there a will that was actually executed when they didn't have capacity? So was it the first one? Well, no, it's the second, because they had different executors. So which one, and different terms in terms of who was to inherit. So which one takes precedence then? You've got the consideration where and this happens often where people are out of date. So head in the sand, or we've got that investment that we can't get the information on, or it's gone down the gurgler, or what does that look like? So they're 2-3 years out of date and they're not up to code. So how can you be able to make that decision and figure out what happens until you get that up to date? So sometimes that is what the challenge can be. So there's plenty of things that can contribute to that as soon as practicable. So I would say, 6 months is the rule of thumb. 6 to 12 is you're probably still going to be fine. Pushing on from that, you need a really, really good reason to do so. Now, there's a couple of rules about the as soon as practicably, and I know again we'll go off piste. I'm a green run person. I can barely ski, so plow.
I've never
I do my snow
skied.
plow. So, I'm going from a snow plow to straight down the black runs here. And I forgot my train of thought. Right. So the as soon as practicable, there's 2 elements of that. So one is in the SIS regs. So SIS reg 6.21 requires that death benefits be dealt with as soon as practicably. So there's a SIS reg implication there if it's not dealt with as soon as practicably under the payment standards. So that's one area. And I already mentioned under the Tax Act with the exempt current pension income. Now, in 2013, when the legislation changed to basically confirm that even if it wasn't reversionary, you still get the benefit of the exemption as long as it was dealt with as soon as practicably. So that was in 2013. And in the rewrite of legislation as part of the transfer balance cap in 2017, that as soon as practicably element actually was removed. So, so in terms of from that perspective, so from a tax perspective, you could potentially, keep it in there for a longer period of time, but you've always got to overlay that SIS side. So even though tax doesn't require it, CIS still does. So overall, you still need that consideration. There's been a couple of private binding rulings that have assessed this as soon as practicably scenario. So again, it was it dealt with as soon as practicably to then get the pension exemption? And so you can see, get a bit of a guideline as to what that looks like. Now, I can't remember what the outcome was. I feel like there was one that was reasonably recent, but again, you just don't want to take the mickey and push it out years. And to be honest, I've seen it. I've seen where pensions have not been dealt with. The surviving spouse has got their own account in there and they're plodding along, and it's 5 years, etc. Hasn't been picked up from an audit perspective. And the tax agent is just, they don't know what they don't know. So they didn't appreciate or realize that it was something that needed to be dealt with. Or then you get back to the, I had to pay it out of super because it wasn't reversionary. And it's a complicated asset, like it's a big illiquid farm or commercial property. So we just kept it in there. And again, the consideration there, well, that's not necessarily the case. It may well be the circumstances where it does have to come out, but that all needs to be addressed. Anyway, there's short story long. Shrug my shoulders a little bit. I think the rule of thumb is the best way to approach it. 6 to 12 months is probably about right from that perspective. And in the situation, so reversionary, you've got 12 months where you get the exemption. With non-reversionary, you can, again, manage that similar time frame. And I would suggest that it's the next 30 June that you would then deal with a non-reversionary pension, because, for self-managed super fund reporting, that's when the reporting happens.
Yeah, I'm assuming that a sort of rubbery time frame, like as soon as practicable. There's another difficult word to pronounce. Makes it that much more difficult, because you touched on this a little bit before with Homer's situation when Marge dies. When you've got a death of say, for example, a spouse, in that case, it's a mildly upsetting experience.
Oh, totally.
You're
exactly.
unlikely to be able to be thinking rationally and locating some of the stuff that you need for this. And that can mean anything for this time frame, really, can't it?
Absolutely. And I think the other thing is that, like everywhere, the courts are backed up too. So the relevance of that is, obviously, if you need to wait for probate to figure out who the executor is to then step into the fund, or obviously Homer's the survivor, so it's a little bit different. But so if you're waiting for that to figure out what's going on, then that 6 months is nothing. It's absolutely nothing. And, those sorts of things can take years to then be dealt with. And you're right, when a spouse dies, it's even if it's expected, it's devastating regardless. So you're asking people to follow rigid timeframes that might not, just from a practical perspective. The other thing we need to be careful or mindful of with any of these provisions as well is, there's this 6 months is a rule of thumb in dealing with this element, but there are other elements in CIS. Once a member dies, that there is a 6-month period of time where action does need to be taken, and that's with respect to the trusteeship of the fund and making sure that's covered off. So some people do want to go down the path of making sure that they do it within 6 months. The other thing I'll say, because I'm conscious of time here, as well, is that reversionary or not, people are like, oh yeah, it's reversionary, it gets dealt with, it goes to the spouse, etc., etc. It's a bit like, I'll akin this to the comment of my will covers it on everything. So unless I want to see the original documents for the pension that say it is reversionary. Homer's original documents that say it's reversionary to Marge, Marge's original documents that say for her pension that says it's reversionary to Homer. Without that, then is it really reversionary? And people think, oh yeah, of course it reverts. And then on the member statement that the software, someone's ticked in there, yep, who's the beneficiary? Reversionary to Homer. But unless you can find for me to support that, the original documents that say it's reversionary, then I would say that that member statement that says that is as useless as a chocolate teapot. You need to see the original documents. And because, as we've sort of gone through very quickly, the transfer balance cap impact of that is substantial in terms of valuations now, reporting sooner rather than later, credit in the survivor's account, restructuring, all of those sorts of things, it can have a substantial impact. So you need, it's one of the, if it's any takeaway, is to double check that the original documents for the pension accounts, you've got them on file to support any of those sorts of things. Again, often we're like, okay, can I see the original pension documents? Oh, we can't find them. And because some of these pensions may have been in place since, you mentioned 2005 earlier, and it might have been in place since, erroneous 2005. They might have been in place since way back when, and then they just benchmarked down to the transfer balance cap. So that situation is, it's still it might be a reversionary, or maybe it wasn't to start with back then. So anyway, just sort of again, all this results in much wider conversations about a lot of other things. But to bring us back onto the green run and my snowplow, trying not to go off piste too much.
Yep, no, that's superannuation documents in general, I think, is probably a topic for another day, but
Definitely.
no less important, as you just highlighted some of the critical issues that need to be determined by those particularly original documents, if you can lay your hands on them. But look, as usual with these podcasts, we've run out of time. So as I always say, we can go on for hours talking about this, but obviously we want to present these in digestible pieces for you.
Correct.
So it's going to go on forever. So that means that we've run out of time today, and we're going to bring this podcast to an end. So just want to thank Jemma, as usual, all the way from Perth, for participating in discussing these critical SMSF matters with me.
And thank you very much for having me, Darin. You make it sound like I'm in, out of Mongolia or something like that. Just in WA, Yes, well, it's a 6-hour flight from Brisbane.
Yeah, it's still
but
still,
anyway.
That's the beauty of Zoom, is that
I know, totally.
We can connect even though we're at different ends of the continent.
Yeah.
But other than that, thank you again, Jemma. Thank you all for listening. As usual, we hope you find this stuff as fascinating as we do talking about it. And we do hope you enjoyed the podcast today. And of course, we hope that you join us for the next time we do the Cross Country Super podcast. So thank you again for your company, and we look forward to doing it all again in the next episode. Bye for now.
Bye, everyone.